got this figured out on TikTok. The microphone is working. Check one, check two. Make sure my microphone is good. Alright, my microphone. Hello, everybody. It's been a little minute. I'm back on TikTok with the weekly stock class for beginners. This week we're going to be talking about option credit spreads. I'm looking forward to this one. This is something that I want to start and using myself even more because these are safer option trades to do than naked calls or naked puts. All right, which is pretty much just buying a straight up call or straight up put without any hedge against it, which I'm going to show you about in these credit spreads. All right, and make sure this primary microphone is right. Okay, that's good. I think we're good to go there. All right. Well, welcome everybody. I'm going to give people a few seconds to join. Let me send out the invites before we get the class rolling. Let me share the live. If you're in here right now, make sure you share the live. Much appreciated. I'm going to put this on Twitter and Facebook real quick. Hope everybody's been doing good out there. The market's been at all-time highs. It's been a beautiful time to be invested. If you haven't been invested, these are the times you don't want to miss out on. This is why you invest for time versus trying to time the right price perfectly. You know, you just got to invest and build your account at first and then use that foundational account to help you grow and be able to have some wealth to leverage over time. Because these pops that happen in the market, you can't always time them perfectly. All right, we got this shared out now. Let's see. I know TikTok like shadow banning my page sometimes, but we're going to get this up and running again. Don't worry. Just got to get the momentum rolling again. That's all it is. If you have not taken our earlier classes already, make sure you go to our YouTube page, Culture Shock Investments, and take the course, the beginner's course. It will help you catch up to understand where we are now. If you're going to be completely lost on option credit spreads, then that means you need to go back a couple lessons so you could gain an understanding of options and understand where we are now as far as these credit spreads. If you don't have understanding of options, then you need to go back even further into the classes and get the understanding of stocks, the basics of stocks, okay? So all that is there for you. I have it all available for free on YouTube, so go check that out. Fergway, what's going on? Thank you for joining. We're going to be talking about some option credit spreads today. Make sure you send the share out, send the invite out. Let me check on my Discord really quick. Make sure they know we are live. And the thing with credit spreads is going to be something that people don't generally jump into early on because they're not as attractive when it comes to returns as naked calls and naked puts. But it's much safer. And if you are just entering options, believe it or not, I'd rather you be doing spreads versus naked puts and naked calls. Those are actually the riskiest calls and puts to do. And they tend to be the ones that people do the most because they see the most profit on those contracts. But with great reward comes great risk, and you don't always want to have to be at great risk to get a decent reward in the stock market. That's not the market we're in. If that's the market you want to be in, then that sounds more like the casino. Okay, if that's what you want, then you want to go to the casino. You don't want to be in the stock market looking for looking for quick returns, okay? Quick 100, 200, 300% returns every time you trade. Make sure you have that in mind. If you cannot get in your mind that a nice 30% return is good enough, then you need to stay away from options because it's going to lead you down a dark path. It may start off bright, but it can get very dark very quickly if you go down that path, all right? I want to be realistic with you all, and that is why I am here today. I'm excited. Welcome everybody joining on the TikTok. Appreciate you all coming through. Make sure you send out the invites. We are going to get this class started right now, okay? Let me go ahead and put the screen up for you. Okay, so Option Credit Spreads 101 by Culture Shock Investments. That is the company name. You can find us, Culture Shock Investments, on all platforms, so make sure you do that, especially YouTube, and go to the earlier classes if you have not taken them already. So let's start off by the simpler. What is a call spread? What is a call spread? A call spread is pretty much when you're going to buy a call and you're going to sell a call. So selling an option contract and buying an option contract is you going to be pretty much hedging against yourself. And that's how you're going to limit your loss in these positions while keeping your upside to cap, but it does provide a decent upside. So you're going to sell one option, and selling the option is actually where you're making your money in this credit spread. When you buy the option that you're buying is actually your hedge. This is to limit your risk, okay? So you're going to be selling the option for the premium to collect premium, buying the option to limit your risk. So the credit you receive is going to be up front when you're selling that contract. And it's going to be like, oh man, this is enticing because I get some credit up front for selling a contract. But you got to know that that credit is only going to be dispensed to you in a certain percentage over time up until expiration. So you don't receive that full credit on the contract until you reach the expiration date. Keep that in mind. So essentially what you're going to say in this is you're going to say a price is going to not go above a certain resistance or not go below a certain support. And that's what you're going to be looking for in a credit spread. You're not necessarily saying that if the stock goes up continuously above a certain level, above a support, that you're going to keep making money. What you're saying is that as long as it stays above that support, you're guaranteeing yourself X amount of dollars. And as long as it stays below a certain price level, you're guaranteeing yourself X amount of dollars. So this is a defined risk. You're going to know exactly how much you're going to make or lose before you even enter the trade. Okay? Income generation. You collect the premium up front. Like I said, that premium amount you get for selling the contract, they're going to credit that to you up front. Now, you only keep that credit if you're going to hold the contract to expiration. So you can't just put a sell in and get the credit in and take the profit out immediately. No, you're only going to get a small percentage if you do that. So you got to make sure that you're paying attention to, as the time goes on, as you get closer to expiration, how much of that premium becomes available to you percentage-wise. And in this concept, I say the same thing applies. You want to look for 30 to 50% profit. That is a great range to start looking to collect your premium. You don't have to wait all the way to expiration because you never know what can happen in that time. With credit spreads, you could be flexible. It can be bullish or bearish, which means they could play either side of the game here. You don't have to do a credit spread only for a bullish market. Like I said, if you're going to say a credit spread is going to be bullish, that means you're going to look for a certain support price level to hold. Remember, those are key levels right there, support price level for it to hold. And if you're going to do a bearish credit spread, that means you're looking for a certain resistance to hold. All right, you want it to stay below a certain price levels. Now, what's the benefit of this? Another benefit is lower capital requirement. This is cheaper than owning 100 shares, but we know that's the case with options, period, okay? It's cheaper than owning 100 shares. That is the power of options. So when do you want to use this? You use this when you believe a stock will stay above a certain level. That's when you're going to use a bull put spread. This is the bullish strategy, okay? This is the bullish version of the credit spread. How do you do this? You're going to sell a put at a higher strike to collect that premium we're talking about. And you're going to see the premium that is going to tell you you're going to collect when you decide what option contract you're going to sell. So you make your decision based on what premium you're looking for. And if that price level makes sense based on where the price is now, and then you're going to look to buy a put as well at a lower strike price to protect you to the downside. So that lets you know. Give it an example here. We're going to use SPY in this example. All right. So let's say SPY is at $500 right now. Your trade setup is going to look like this. You're going to sell a $4.90 put. Right. The $4.90 put, collect $3 of premium, and you're going to buy a $4.80 put, and you're going to pay $1 in premium. Okay. So that's going to leave you with what? You're going to end up collecting how much? Net credit of $200 on this trade. So you're going to collect a net credit of $200 because you are also buying this put for $1. So that takes away from your $3 credit down to $2, which is really $200. I said $2 to $200. All right. So 2.0 in option world means $200. Don't forget that when you're looking at contract prices. Don't think this is $2 when you go to buy an option contract. That's $200. Okay. So when you have a 500, let's say SPY's at 500, this is a bullish put spread, right? So what you're saying here is that you're selling a 490 put, is saying that SPY is going to stay above 490. So as long as SPY stays above 490 by your expiration date, you're going to collect this $200 premium. What you're buying the put for is to hedge just in case SPY comes down below 490. You want to have this hedge in place so you don't end up losing all your money from this put side. Because if you just sold a put without buying a put, this would be a naked sell, and that's much higher risk than this credit spread. Okay, so this strategy is about lowering risk and collecting consistent premium. That's what we're trying to do here: lower risk and collect consistent premium. That's the key. You do not want to get caught up in a situation where you are trying to always constantly maximize profit, because that's going to put you in the most risky situations all the time. You want to find strategies that work with your capital that's in your account, what you have available to work with. So if you have a certain amount of capital in your account where you don't feel the need to necessarily take high risk anymore because you've built up a strong foundation in your account, then you need to start leaning more into strategies like this to maintain your wealth and allow it to keep compounding and growing. When you're early on and starting off investing and you're just starting in the option game and you're starting off with your first $100, strategies like this may not make sense to you because you're looking at it like, oh man, what am I going to collect? $20, $30? Yes. So you want to look at something that maybe is going to give you a better option of return as long as you're doing your homework in advance. That's where you get the naked calls and naked puts. But you have to be very understanding of the risk that's involved with that. But there's a lot of reward involved with that, where you could end up building your account quicker and ending up in a position where you don't have to take that risk anymore. That's the goal. The goal is always to get your account to a position where you could minimize your risk, and off that minimum risk, you're still making enough money to be happy with your returns, okay? Where you're making 10% a year on your account, and that 10% a year pays off all your bills, and you still have extra capital left over to vacation and do things that you want to do. That's the point you want to get to. And that only happens when you start mitigating your risk as your account grows, all right? So let's go ahead. Let's get back to it. So the bull put spread, this bullish strategy, like I told you, this scenario, SPY stays above 490, you keep the full $200 premium. So that's when you get maximum profit. This has to be the case at the time of expiration. So if you bought this contract on a Monday and contract expires Friday, you got to hold that option contract until Friday for you to get this full $200 profit. If SPY drops below 490, you're going to see a partial loss. Why a partial loss and not a complete loss like you would if you didn't buy that put? Is because you bought that put contract as well. So when it goes below 490, that put that you bought is going to be going up in value, and it's going to offset the loss you're taking from the selling the put. All right, so that's the purpose of buying the put. Now it gets to a certain point where the max loss gets reached on the contract, and that max loss price is going to be if it gets way below your support level that you're looking for to hold above, which is 490. If SPY gets below 480, then that premium is going to be lost, and you're going to end up in a loss on this trade. So no trade is full bulletproof. And remember, in this scenario, the main thing I want you to remember right now is that the below scenarios are telling you about the outcome at the time of contract expiration. You can always sell this contract before expiration, cut your loss early, and take profits early it still doesn't have to get all the way up to $200. You could take profit before then. So let me break down the math. Let's break down the numbers. Let's get to the numbers. Everybody here with me? Hope y'all sticking with me. Y'all understand what we're talking about. Oh, hold on. Let me make sure I'm sharing. Goddess is in the room. I didn't even know you was in here. What's going on? Make sure I'm sharing the slides with you over here. But all right. So this is the math, right? This is the math on the bullish put spread. Like I said, less risk, a controlled reward, but that's okay. If you can consistently do this on a weekly basis, you'll compound your wealth rapidly. Maximum profit, $200. So that's the cap profit. Maximum loss is going to be the spread width minus the credit. So the max loss, the spread width is just telling you when we go down from 490 to 480, that's a $10 dip, right? But we also already received a $200 credit on this trade. So that credit is going to offset about $2 of that spread. So that's why you end up with an $800 loss if it goes down below 480. If SPY drops below 480, this is going to be your loss on this trade, $800. The break even is going to be if you end up around 488. If it goes down to 488 and at expiration, SPY's at 488, your premium just gets absorbed by that pullback and you just end up neutral. All right, you don't end up with any loss, even on a pullback from 500. So mind you, keep that in mind. I want you to keep that in mind because that's an important point. That SPY, you're doing this when SPY's at $500, right? And you don't end up taking any loss on this trade until SPY gets below 488. So at 488 even, you're still neutral. That's a $12 dip. And that's a pretty big move for an S&P 500 to make. So you can guarantee yourself $200 as long as SPY doesn't dip more than $10 on this trade. Let's say within a week's time, maybe in 2 weeks' time, depending on the contract time frame. You know, for me, a contract like this would be, hopefully this will be within a week, so I only need this to work until Friday. That'll be lovely. I'll have high confidence in that playing out. But the key to understand here is that if you're in a naked call, right, and you bought a call on SPY at $500 instead of doing this credit spread, as soon as SPY starts dropping below $500, you start losing money immediately. So SPY goes down to $499.80. If you bought at $500, your contract is going to be down some kind of percentage. So this is the key benefit of these credit spreads, is that you could sustain some kind of fluctuation in price. As long as it doesn't fluctuate past your parameters, you will be good. You will still make money. And that is the key benefit of this trade over buying naked calls and naked puts. All right, let's get back to it. Now we're going to know about the bearish side. We got to know the opposite way to play. We got to know both sides. You always want to know both sides. And the bearish strategy is pretty much the same strategy in reverse. When you believe the stock will stay below a certain level, you will do a bear call spread. The bear call spread is when you believe, like I said, the stock will stay below a certain resistance level. So let's say you're watching a stock and you see that it's holding up on the chart below a certain resistance level, that you charted out your weekly levels like we talk about, and you see, all right, I see we hit a resistance here and we're actually starting to pull back off of that resistance. And I believe it's going to stay below that level. And actually, I see the stock getting weaker. I believe it's actually going to dip. I don't believe it's going to stay in any kind of range. I'm not doing this on consolidation hopes. I'm doing this off of a bearish belief that the market is going to dip. So I see the market dipping, is breaking certain levels that I see going down. Once I see it get below a key level that I have charted, that's when I want to enter this trade and say, all right, I believe it's going to hold below here and actually go further down. And as long as it does, I'm going to collect this premium. That's what you want to do in this position for the bearish call spread. That's why setting your levels are important, so you know when and what strategy you want to implement based on where the price is moving. So how this works. Remember before we were selling calls and selling puts and buying puts. This time you're selling a call and buying a call. Now to your brain, this may seem counterintuitive because you're like, well, this is a bearish strategy and I'm selling a call and buying a call, and in the bullish strategy I'm selling the put and buying a put. So the selling aspect of it is what you're making the money off of. So this is bearish because you're selling a call. All right. And the other one is bullish because you're selling a put. So selling a put is going to tell you the opposite of a put. So put, you think the market's going down. If you're selling the put, you think the market's going up. All right. So just remember that. I know it may confuse you when you think about calls and puts, but think about it in that way. If you're selling the call, it's complete opposite. You're thinking the market's coming down. If you're selling the put, you think the market's going up. So you're selling a call. You think the market's coming down. So you're buying a lower strike and you're going to buy a call at a higher strike. So the example here is going to be Tesla. Tesla current stock price is $250. Your trade setup is I'm going to sell a 260 call because I believe Tesla is going to go down even further. So I'm going to sell a 260 call, collect my $4 premium, and then I'm going to buy a 270 call. Just in case Tesla goes up, I have a 270 call. See that $10 spread between these two positions? Now, on a lot of platforms, what you'll see is that now you could go on platforms like TradingView, on Robinhood, E-Trade, Webull. They have a lot of these spreads set up for you already, and you just got to pick which direction and what strike prices you want to trade at. So you don't have to go through putting each one of these legs of the trade, but I recommend when you're first starting off that you start setting up the trades on yourself and making sure, so you make sure you understand how the trade is put together. So then when you go over to just the trades that they have put together for you, you understand each leg of the trade and what you're looking at. You don't want to just jump into the bull and call and bear call spreads that are on and already made, because you may not completely understand which direction that setup is favoring just based off of what you're looking at. You got to know how to set up the trade. So do it yourself first and then start using those. All right. Let's move on to this strategy, this trade setup. All right. It's going to net you to credit another $200 net credit trade here. So what you want is Tesla to stay where? In this situation, where do you think you want Tesla to stay? In this situation, you want Tesla to stay below 260. All right, you want Tesla to stay below 260. As long as Tesla stays below 260, you're going to be able to collect your $200 premium. As soon as Tesla goes over 260, you're going to start losing out on this $200 premium. And how far above 260 does it have to go before you start losing money from it being at 250? Let's see if y'all remember. That's going to be answered in the next slide. Let's see if you remember. All right. Same scenario, played on opposite direction. Tesla staying below 260. You keep your full $200 profit by time of what? By time of expiration. Before time of expiration, if it expires by the end of the week and you want to take your profit on Wednesday, you may have $100 profit. You may have 80s. You may have $120 profit. And you may be happy with that because maybe you see Tesla starting to reverse and get stronger and you're like, you know what? Let me just collect my premium now. I don't want to hold it till Friday because that's the kind of market we're in right now. It could swing from the middle of the week to the end of the week. It could go from bearish to bullish. Tesla rises above 260. You suffered a partial loss, but not complete loss. Why? Because you have the 270 call. The 270 call is going to offset your loss. Tesla rises above 270 is when they say you suffered a max loss on this trade. Max profit. This is where I asked the question earlier. Remember I asked you, when do you start losing money on the trade? We're going to find out right here in the math. You got to do the math. The max profit is $200, as we know. That's the credit you receive on the trade. The max loss, the spread, the $10 minus the 2. You're going to lose $800 on this trade if it goes down past that range. Okay, if it goes down, if it goes up above your range, if it goes up above 270, you're going to start losing money. 260, you're going to start losing money. I'm sorry, it's at 250. If it goes above 260, you're going to start losing money. Now, how far above 260 does it have to go for you to start losing money? You said the max loss is going to be around 270. So that'll put you at an $800 loss. Your break even will be if it goes above 260 to 262. So starting from 250, you enter this trade at 250. Tesla's at $250. and you said, all right, let me enter the trade, and Tesla starts to come up, and you're wrong on the trade, guess what? You have more cushion than someone who entered a naked put. Because someone in the naked put, as soon as Tesla goes up to 251, their contract is at a loss. And how I know Tesla contracts to move, they're going to go down pretty quickly if you're wrong on a Tesla direction, because those contracts are very, very volatile. Okay, so this is actually a great strategy to use on things that you feel are more sturdy. I like using this strategy on things that you know are going to not jump up or go down crazy in price, because if they do, it could break your spread and you end up in a loss. So I prefer a strategy like this on something like ETFs and things that are more controlled in their price movement and not so rapid and volatile in their change, because that's how you get caught out there. But you want to avoid those companies, period, especially with naked calls and naked puts. But this is still a safer route if you were to trade a company like Tesla versus doing a naked put. You would rather do this bear call spread. All right, and your risk is going to be a whole $12 move has to happen to the upside, which can happen in Tesla pretty quickly. It has to happen before your expiration in order for you to break even. And then after that $12 move is when you'll start to lose money, and only a partial loss of your capital. So like I said, it's much safer. I still would prefer to do the strategy with ETFs, because ETFs give you more of a controlled range movement versus volatile stocks. But this is still safer than a naked call or put either way. Let's move on. Credit spread versus buying options. This is what I'm talking to you about. So buying calls and puts, your risk is can be low and reward is high. They say your risk is low because you can only lose what the premium of the option contract is. But I'm telling you now, your risk is not low if you're doing that frequently. If you're frequently buying naked calls and naked puts, your loss is controlled to whatever the option contract costs. So if it costs $200, you can only lose $200. No matter how far the stock goes down, if you were wrong, you still only lost your $200. But if you consistently do that and you keep taking those complete losses, you're going to end up losing your capital in your account very quickly and blowing your account. Now, the risk here on credit spreads is defined. Reward limited, reward high. When you're buying calls and puts, like I said, higher risk, higher reward. They say low risk here, but like I said, low risk only because you can only lose the money you put in. The win rate on these are actually much lower as well. Because why? Like I said, as soon as the stock starts moving in the opposite direction of what you bought, if you buy a call and the stock starts moving down, as soon as it moves 1 cent, 2 cents down from where you bought in at, you're starting to lose money. So the win rate on those naked puts and calls tend to be much lower than credit spreads, which is why people who have larger sums of capital tend to do more spreads versus naked puts or calls. They probably exclusively stay away from puts and calls at a certain point. And your win rate on the credit spreads is higher. Why? Because you have a defined range that you are trading, and it gives you a cushion. Like we said, on most of those trades, for a move like that to happen, especially on the ETF, is not very likely unless you have some high volatility in the market at the time, and even then, it's more likely that you walk out of that trade with money than doing a purely naked call or put. So market condition, what to use and when to use a credit spread. When the market is slightly bullish, you want to do a bull put spread. Remember, put spread is a bullish trade. I know it says the word put in it, and that may throw people off, but this is a bullish put spread. And when the market is slightly bullish and moving up and you're trading a support level, this is the strategy you want to use. You want to use this bullish put spread because you're using the support on the way up, and you're just letting it go ahead and you're collecting your premium week after week, week after week. Slightly bearish market, the opposite. You want to do the bear call spread. The sideways market, you could do either one. And honestly, in this case, what I'm thinking is that if you have enough capital to do one on both sides, and you're sitting within a nice range, you could play on both sides and collect premium on both sides, because your bull call spread will stay in the range, and your your bear call spread will stay in the range, and your bull put spread will stay in the range as well, because it's staying in consolidation. If a stock is consolidation in the range, then that lets you know that, okay, I could collect premium on both sides. And then if it breaks to one side versus the other, at least you collected premium on one side and you took a loss on the other, and you could maybe cut your loss at a partial loss. But as long as it holds that range up until your expiration, you could collect full premium on both sides. And that's a benefit of these call spreads as well. Of these credit spreads. Very, very good benefit right there. I like that. I like it. Any way you could collect money and lower your risk, I like it. So risk management rules here. Risk no more than 1 to 3% per trade. That's 1 to 3% of your total account. I know that may sound like a little bit to you, but that's how you need to be looking at option trading. Option trading is not something that you want to be putting 80% of your account into. No, you need to be invested in the long term. That's where the money is made. All right. These are like income generating tools that you can use to rapidly increase the growth and compound of your account by taking these profits and dumping them into your long term. Or you could just use this to help you live, function, and do things in your day-to-day life. But that's why you want to keep it limited to 1 to 3% of your account. So build a majority of your account in long-term investments, vary in risk, and then option trading is highly, highly, highly risky. So you want to keep a small percentage of your account dedicated to this, especially when you're just learning how to do it. Okay? Close your profits at 50 to 70% profit. I like 30% plus. So 50 to 70% is great. That means you don't have to wait all the way into expiration. You can avoid some kind of last minute pivot and reversal in the market and ended up taking a loss on a trade that you were up 60% in. Avoid taking these kind of trades, these credit spreads on earnings, unless you are a very experienced trader. And even then, that's still something I would not do, because earnings have high volatility spikes and they cause risk, and that will break your spread easily. Trade liquid stocks that have good volume behind them and keep within a decent range and hold their supports a lot of the times when they break them and stay below resistances. Stocks that respect their price levels. Volatile stocks don't respect price levels. They'll go up on you, they'll break a price level, a weekly level, and gap up above it, and then come back down below it, and 2 weeks later it will do all kind of crazy things. So you want to find things that have high volume on them, like SPY, Apple, and trade within they respect ranges, and they respect their levels. When they touch those weekly levels, they show them respect. Okay? These are the kind of companies you want to do credit spreads on. And help you with easier entry and exit. That's another major key. You want to find things that find easier entry and exit. Those volatile stocks, find those entries and exits are a biatch. So the assignment this week for everybody, I want you guys to pick a stock. Pick SPY, Apple, Tesla, Google, Microsoft, whatever, Nvidia. And I want you to build one. I want you to build a put spread. I want you to look at the weekly levels. I want you to look at the momentum. And based on that, I want you to develop one of these strategies. I want you to put together a bullish put spread or a bearish call spread based on what your price levels are telling you. I want you to write down the credit you receive on the spread that you're choosing. I want you to write down what your maximum loss is going to be on that trade. You should know this in advance. I want you to write down what your break even is going to be in this trade. These are all things you should know in advance before entering the trade. And then I want you to ask yourself, what price does the stock need to stay above or below for me to profit? Okay? Simple assignment. Run the credit spread. You could do this through one of your brokerages. You could do it through paper trading. You could set it up the way I just taught you how to set it up. Buy and sell. And see what the outcome is by the time you get to expiration or before you get to expiration. You may see, oh man, I could take profit here. And you can see how that will play out week after week for you, and how you can keep collecting premium and growing your account, because that's really what it's about, building wealth. You don't want to only use this for just strictly spending income. Like I said, take this profits you make from your option trading and dump it into your long term. I know it seems like investing to investing, but it's investing to equity, really. Your trading is really taxable income. So once you make the money on that trade, you're going to be taxed on that. You're already taxed. So you might as well throw it into your long-term investment and turn it into equity that you can now borrow against, so you become your own bank. And that's the kind of stuff we teach in the Culture Shock community, which is why you need to subscribe today and to the Discord. Make sure you're following us on TikTok and YouTube and all the platforms, so you can learn all the different ways to maintain and build your wealth. All right, risk management is key. Here is the link for you guys to subscribe. Make sure you scan that QR code on the screen. Follow us on all platforms. And I appreciate you all coming through for the lesson today. I hope you learned something. I hope TikTok didn't shadow ban me like they always like to do, because they try to say this is like pre-recorded, which is crazy, because it's definitely not pre-recorded. But let's see. Thank you all for coming through again. Hope you learned something. If not, run it back, take some notes, and ask questions. I'm here for you. Ask questions in the comments, and I will make sure to answer those questions and respond and help you out in any way I can. And the best way is to join the community and join our live sessions and the live charting sessions we do and classes we do during the week, and the live trading we do. Nothing like getting into action and being live, all right? And seeing how things are flowing in real time. So see you in the sessions. All right, y'all. Peace.